and welcome back to, it's been a little while since we've had Jeff on with us. So, Jeff Clark, how are you doing?
Mike, it's so great to be back with you. I've missed doing these videos with you. I'm fresh off the New Orleans Investment Conference, which was very interesting, but I'm really glad to be back with you, Mike.
Excellent. I want to ask you about the New Orleans Investment Conference and how that went, because I'm sure that a lot of listeners want to hear about that. But first, I wanted to talk about this Crescat Capital article. They've got a monthly newsletter, and it's very in depth. And they do a lot of analysis, and they've got a lot of charts. And you know how I love charts.
Yes, I do.
The first one is down inside this article a bit, but it's the effective Fed funds rate versus CPI year over year. And so, basically it's real interest rates, pretty much, the Fed funds rate. And it just hit a record. Negative interest rates, record 5.3% negative, beyond, a break even on the Fed funds rate. That's huge. Got any comments on that?
Yeah, that's historic right there, right? That we've never seen negative rates. That exceeds what we saw back in the 1970s. And of course, that was a very big impetus for gold and silver prices rising back then, right? So, but Mike, the knee-jerk reaction some people are going to have is, well, yeah, but the Fed is going to raise rates now. That's all the talk, especially in the mainstream. They're going to raise rates. So what about that, Mike?
Well, the Fed, I recommend that people read this article because it basically it is a whole lot of evidence for what I have been saying for a very long time. The Fed has been busy painting themselves into a corner. Well, right now they've got a lot of paint, but they're running out of floor.
Right.
There's almost no unpainted floor left. They are backed into this corner. And if they raise rates, it crashes the economy. You can't raise rates when you have elevated the stock market so artificially just by printing. And to print, you have to issue new bonds. And when people bid on bonds, the rates go down, not up. If the Fed is buying them, if you raise rates also, what you're doing is you're raising the amount of interest that the government has to pay to roll over the debt. And I believe, it used to be, I believe that they had to, the average that we were financed, you were basically paying off the debt every 4.3 years. So you had to roll over the debt. We've got 30-year treasuries and we've got 3-month. And and a range all in between this. And so as you're refinancing, the average was 4.3 years of debt that we're paying for. So in order to create the amount of currency that they have to create to keep the stock markets from crashing and keeping a very bad recession, if not an uncontrollable plunge into a depression from happening, the Federal Reserve has to create currency. And to create currency and stimulate the economy, they need to keep interest rates low.
That almost sounds like Hidden Secrets of Money episode 7, what you're describing right there.
Yes, it does. So it's very nice to see it isn't nice. I'd rather that all of my predictions don't come true.
Right.
It would be much better for the general economy and the world. My predictions are predictions that are only good for precious metals investors. But then, if you scroll down a bit in this article, we get to somewhat proof that the bull market in precious metals is not over with, and that this, a lot of people say that we've been in a bear market since 2011, and I completely disagree. I call this a mid-cycle correction inside of a giant bull market, just like we had back in the 70s. And when you come to gold and silver miners, the M&A cycle, mergers and acquisition cycle, so how many mining companies are being acquired, it shows that we're nowhere near a peak. We're actually at the bottom where things launch. And so this shows that this portion of the cycle is barely getting started. And then one that you pointed out earlier, the silver to government debt ratio. Now, in my book and in several videos and on my insiders, I've done charts like this, but I usually use gold because gold is the central bank. It's one of their tier one assets. And so it's silver is money and a commodity. Gold is money. But this is really interesting, seeing how much that silver has to make up for. And look at where the zero line is. It's amazing. You got any comments on those last two, mergers and acquisitions and silver to debt ratio?
Yeah, as far as M&A, mergers and acquisitions, it is at a low, and so there's a lot of potential there, and it's likely we're going to see a strong uptrend in M&A. Part of it was because of COVID, right? Analysts couldn't go on site and look at these projects and evaluate them and make recommendations. But now things are starting to loosen back up again. So on that reason alone, we're probably likely to see a lot more M&A. But a lot of these majors and big producers, they need to replace ounces. Every day they operate, they are one day closer to being out of business. So they have to replace ounces. It's a constant focus of these management teams. And so we're going to see some more M&A, and that shows you just how low it's been. So there's a lot of potential there for more M&A.
That's a great quote, by the way, is every day they operate, they're one day closer to being out of business.
That's
every
right.
mine has a limited life cycle. But what I see here is that when mergers and acquisitions explode, that says you're getting near a top. So
and you can see that's what happened. That top, where the top blue lines there are, was in 2011, and that was actually the top of the market. And you can see we're at the opposite end of that now. So we're nowhere near a top in the market. So there's going to be a lot ahead. And that's good for those of us who own some of the mining stocks, like some of the ones you've disclosed to insiders, Mike. So some fun days ahead, I think, for that.
Well, it's also good for anybody that's interested in buying precious metals. It says that this bull market is just beginning again, that we're back to, there should be some explosive moves in the next few years here. I really think that, we've got at least another 2 or 3 years left to this, and it might be longer, but it's going to be, I really think it's going to be spectacular. And I just can't imagine gold ending up at, peaking at anything less than like $5,000 to $10,000 an ounce. Mm-hmm. So silver to debt ratio. What do you think about that?
Well, look at the peaks before, back in 1980 when gold and silver peaked, and back in 2011 when gold and silver peaked.
Yeah. Well, this chart only goes back to 85, so it doesn't even show the 1980 peak. I wish they had shown that, because it would have been several times higher than it would have been off the top of this chart.
Right. So this implies that, there's a lot of room to the upside yet for silver in relation to government debt. So, and there's a big difference. We didn't have as much debt back in the 1970s and 80s, right? When gold and silver really ran high back then. Right. Debt was a lot lower than it is now. So,
which means the metals have to make up for lost time,
Exactly. Yeah. It's that accounting thing you've always talked about, Mike, and you talk about in your book. There needs to be an accounting for the amount of debt and currency creation relative to the prices of gold and silver. So, we're near a low in the cycle for gold and silver, not near a high.
And then the next chart, they've got gold tends to struggle after hitting new highs. And you see the bull market of the 70s, and there's a first phase where it goes up and it hits that dashed line, and then it does a pullback, the mid-cycle correction, and then it's the third phase where it just goes ballistic and it hits new highs. That little correction from the first day of 75 until late 76, and then back up again to 78 or 79, and then it broke past that 100. I can't remember exactly what the high was, but it broke past it and exploded up to 850. That is what we've been through. You know, I've shown this many times before, where I take the price action of today and overlay it on the 70s by compressing the time scale of today until it matches up with that time scale. And it's like we're right on track. It just fits that exact pullback right from gold's low up to the first peak and then the pullback. And so I really think we're set for the explosion into this third phase. And I think that's coming over the next couple of years.
Yeah, I like what I've observed there, Mike, was if you look back at the mid 70s correction, it was 15.3%. And look at ours now, it's essentially 15%.
Yeah.
The mid correction back there in the 70s was 18 months, and we're at about a year now. So 2022 could be could be very interesting for gold and silver.
Yep. Yeah. And then skipping down to one that I was talking about earlier, silver versus real interest rates. This is very interesting, and I haven't done this chart before. And you know, normally when I talk about these articles, I've usually covered everything sometime in the past, and here is something where I've never really covered it. But look at the astonishing correlation, how closely they track each other from 2000, beginning of 2012 until the pandemic, and then the divergence. And there's only three things that can happen here. First, inflation could suddenly fall way back, and they would correlate once again. Second, they could raise interest rates dramatically, which isn't going to happen. It's not they can't raise them dramatically without crashing the economy. Third, and the most likely out of this scenario by far, is that silver explodes and rises significantly. And that's what they've put a little yellow arrow in here to represent the silver explosion. And I do think that is exactly what's coming. And they've got it way up in the mid 30s here. But by then, the U.S. 5-year real yields will probably have moved higher also. So you've got mid 30s to $40 silver, and right now we're talking mid 20s. So this is something spectacular. It's predicting something spectacular coming very shortly.
Yeah, there is some separation there. That's a remarkable correlation, though, over the past decade, right? Just how well they've correlated together. Now they've separated. So yes, it implies that either rates have to go up or silver has to go up. So rates have to come down. I'm sorry.
Well, inflation has to come down, or rates go up, or silver goes up to make up for the difference. Right.
And that's the other thing about the real rates is even if they do raise rates, which you're right, the Fed's boxed into a corner. What are they going to do? They can't really afford to raise rates, but they may be forced to if inflation continues to run hot, because foreigners are going to demand higher rates for, payments on their bonds and treasuries and all that. So, but even if they do raise rates, if inflation goes higher, the real rate would actually get more negative. So it really is an interesting thing. This all implies that silver is still dramatically undervalued and is much more likely to rise than do anything else here over the next few years.
Yes. And then lastly, there's gold versus the currency supply. And they're talking about the M2 currency supply here. And this is one chart that I've been doing since I first started this. Back in 2004, 5, 6, 7, nobody was really doing this, but I was doing base currency, M1, M2. There used to be M3 back then. Now I do it with MZM, which they've discontinued. But in all scenarios, it doesn't matter what scenario you look at, gold is way, way undervalued compared to the amount of currency that they have created that you can purchase gold with or purchase anything with. So, and then when you do the gold to, the gold silver ratio, silver is way undervalued compared to gold. So, yeah.
Right. And again, just like the other charts, Mike, look what happened in 2008 with this ratio. Look what happened in 2011 with this ratio. And that's when the gold and silver prices peaked. We're dramatically undervalued relative to those periods. So this would imply that there's going to be another accounting, like you've always point out throughout history, and that means that gold prices are going to have to rise in response to this.
So, Jeff, this article was excellent. Thanks for your input on it. But tell us how your conference went, the New Orleans Investment Conference.
Well, it was my first time there, and I thoroughly enjoyed it. It was just wonderful to be there. It was actually well attended, I have to tell you. There were over 500 people there in person attending the event. Plus, it was a hybrid type event, so it was both live and online. So over 500 people plus the online people that were watching. So it was well attended, and it was a lot of fun. I really enjoyed mixing with people, meeting a lot of people. So that's where to meet Mike and I is, if you want to do that, is to come to some of these conferences. So, but we just went through some Tavi Costa charts there, Mike, of Crescat Capital. And I actually got the chance to meet him and actually have dinner with him and some other people. So I got to know him a little bit. And I have to tell you, Mike, he's the real deal. He knows what he's doing. He's an excellent macro analyst, and he's a very good follow. If you want to subscribe to his newsletters or follow him on Twitter or whatever. But he's very, very knowledgeable in what he covers. And after looking at the macro picture, he comes to the same conclusions that we have come to. So I thought that was very interesting. But I got to meet a lot of people like that. It was really enjoyable and a lot of fun. And it was very helpful. I mean, it's an investment conference, right? So there were lots of great ideas on, what to invest in and things like that. But most speakers there, I have to say, they're not gold bugs per se, but they see the case for gold and recommend that everyone needs to have exposure to gold and silver at this point in time. It's critical, important, because they actually use the same words you just used, Mike. The Fed is trapped. I heard that multiple times at the conference. The Fed has painted themselves into a corner. There's really no healthy way out of this. And that implies a lot of topsy-turvy events ahead and probably some type of monetary crisis. So it was interesting to hear them repeating things that you've been saying all along.
Excellent. So the general consensus at the conference is that everybody feels that there's something coming, something soon, and something really big, right?
Yes, exactly. And a lot of it was centered around the Fed. It's like, what is the Fed going to do? How are they going to get out of this? Are they going to raise rates? What happens if inflation is not transitory? I would say a year ago, a lot of people thought, the Fed statement about inflation being transitory was true. Now there's a lot of doubt, not just from Fed officials, but we see this definitely in the private sector as well. A lot of analysts and a lot of economists don't think inflation is going to be transitory. It's going to last a lot longer. And of course, there's a lot of implications that come with that.
Awesome. Well, thanks again for joining me on this video, because I really missed you guys, you and Adam. And you've got something coming up on Wealthion, don't you, with Adam?
That's right. Just real quick, Adam's going to have me give my talk, my workshop talk, which was primarily just on miners. There'll be some speculative miners there that I do cover in that talk, but I'm going to redo my talk just for Wealthion. So he's going to have that video available if you want to check that out over on his channel here in a couple of days.
Awesome. I want to thank everybody for watching, and thank you again, Jeff, for joining me on the video, and we'll see you all next time.
It's great to be back with you, Mike.